Morning and welcome everyone. Thanks for tuning in to this Ask Us Anything session. Really looking forward to answering as many questions as we can today. We will be sending a recording at the end of this session, so you can always watch that back and be uploaded to YouTube as well. And any questions we don't get to, we'll write a blog post about those in the next week's newsletter. I'm Tom, and this is Ben. We'll be hosting today. Hey Ben.
How's it going, Tom?
Doing well, thanks mate.
Very excited to be here. So just before we begin, sort of a bit of a legal disclaimer. When we are answering these questions, we just want to note that the information we share is general in nature. So it's not going to take into account your personal objectives, your financial situation, or any of your needs. So we always advise that you consider the PDS or product disclosure statement available on our website before making an investment decision. So Tom, there's so much to discuss and learn when it comes to ETFs. Things like portfolio construction, asset classes, ethical investments, trading considerations. The list just seems to go on and on. Sometimes it's really difficult to know where to start as a new investor.
Yeah, definitely. And we had hundreds of questions come through when people signed up for the webinar. So what we've done, we're going to launch a poll through the webinar to let you guys decide what topic we'll cover first. So there are 3 different topics that we broadly put the questions into. The first one will be the research phase. This is really when you're really starting your ETF journey. You want to figure out what they are, the basics, and how to compare ETFs. The second section we put is the ETF deep dive. So this is really some of the mechanics behind ETFs, how the indexes are constructed, the fees and whatnot. And then finally, actually investing. So more around portfolio construction, how many ETFs should you have, and how to actually choose ETFs. So that poll should be up there now. We'll let everyone decide what section they want to cover first. What section are you most interested in, Ben?
Look, I think for me, not to sort of influence the voting, but I think the most interesting one would be actually investing, hearing about all these different ETFs and ETF ideas, but how do you actually sort of get into them and get involved in that process to start with? How about you, Tom?
I think for me, it's the deep dive section, the actual mechanics behind the ETFs, the index construction and all the goings on with that. So I think we should have we're still going with the poll.
Tom, do you just want to talk maybe a bit about what you do at BetaShares to share with the audience and sort of who you're engaged with on a day-to-day basis?
Yeah, definitely. So I'm an account manager in the broker services team. So that means I interact with more of those traditional broker style firms, so people like Shaw and Partners, Morgans, Macquarie, and I just work with different brokers there and advisors there to give them up to date on our funds, provide analytics, have meetings and whatnot. How about yourself, Ben?
Yes, I'm sort of in a role that supports you there, Tom. So helping provide a lot of those analytics and helping advisors with portfolio construction.
Okay, great. So it looks like the poll is done, and looks like you did influence the vote there, Ben. We'll be starting on actually investing with 52% of the pollers answered that section. So look, as I mentioned, we had hundreds of questions come through when everyone signed up for the webinar. So what we'll do is we'll just go through some of the questions we've put under the actually investing section. And then after about 20 or 25 or so minutes, we'll start a new poll. We'll choose another section, and then finally, do feel free to send questions through as you go. And we'll have some time for live questions at the end. To kick us off, John asks, are there ETFs that target a different outcome? So capital growth versus income?
Yeah, so there definitely are. So we actually specify this on our website. You can look at different sort of targets that ETFs might specifically look to achieve. So for example, a lot of our thematic ETFs, particularly the ones that are related to growth or technology stocks, are more sort of targeting that capital growth aspect. Where if you look at sort of the more fixed income aspect of your portfolio, those sort of ETFs are looking at achieving income for investors. And we break that down really clearly on our website, where you can split ETFs by equity income or fixed income or capital growth. So that's a really good resource there. But yeah, they're definitely, ETFs will target different sort of investment goals, which will obviously depend on your personal goals for investing.
Yeah, definitely. There's such a diverse range of ETFs available now as well, because it isn't just stop at capital growth. And income is also defensive style ETF, so it's sort of ETF backed by physical gold, for instance, traditional defensive asset class. So there's such a wide berth.
Yeah, very broad range. Thanks for that, John. So Mark has just asked here, this is an interesting one. How many ETFs would you recommend to hold, Tom?
Okay, good question, Mark. It's one we do get fairly often because people, they hear ETFs give you instant diversification, so maybe you just need to hold one ETF and that's enough. But there's really no right or wrong answer, and it does go a bit back to how diverse the range of ETFs you can have access to now are. So if you wanted to, you could go out there and buy, an Australian ETF, a global ETF, and a few thematic ETFs, and also a bit of fixed income and gold, as I mentioned earlier. Well, there are even ETFs now that are diversified, and they actually hold a basket of underlying ETFs, and these are called diversified funds. We've got a range of them. So we've got our DHHF, which is just a high growth diversified fund, for instance. We've also got things like ethical diversified funds. So just under a single ETF, you get exposure to global equities, domestic equities, as well as fixed income. So in that instance, you could use a single ETF, or you could be really hands-on and break it down into different thematics you enjoy. So there's really no right or wrong answer. One thing to consider though is if you are buying, a large amount of different ETFs, just do check, if there's a large overlap there and are two of them very highly correlated, because generally you want to be diversifying yourself when buying multiple.
Yeah, and you can see all that information usually on fund web pages in terms of the underlying holdings, if there is that sort of overlap there as well.
Exactly, and the sector breakdown too, right? Yeah. So that's really handy as well. Thanks, Mark. Jennifer's asking, if I have multiple ETFs, is there a best practice minimal amount I should have in each? Okay.
Yeah, so sort of similar to Tom's answer, it really just depends on your personal investment style, whether the ETF you've picked is a core holding or if it's a thematic, so how much you're going to allocate to each of those. We don't have any minimum requirements for investments in our ETFs. Perhaps the only thing to consider there would be that a lot of brokerage houses actually do sort of include a minimum investment amount. So a lot of the banks will have a minimum of $500 for that initial brokerage.
Yeah, okay, definitely. Good point. That was Jennifer's question. So Zoe's asked, if ETFs are supposed to diversify your portfolio in one trade, why would you buy a thematic ETF? Thanks, Zoe. Well, I can probably take this one, Ben. It actually goes back to a little bit on what I touched on earlier, whereby you can buy a single ETF that gives you great diversification across a lot of sectors, but also not every ETF is going to give you broad diversification. So a good example of this question is if you bought the ASX 200 ETF, A200 is one where you have, that'll give you exposure to the top 200 companies listed on the Australian Stock Exchange, which is great for diversified Australian exposure. But in the Australian market, we don't have much exposure to electric vehicles, for instance, or robotics and AI. So it comes back to portfolio construction and a little bit around core and satellite investing. So your A200, and that's just one example for the domestic market. You look at the NASDAQ in the US, for instance, or even broad global indices. That could be a core holding. And then satellite positions like thematics, like electric vehicles and robotics, can be used on the sides to provide exposure to that industry. And they also tend to be a little bit more high growth in those areas.
Yeah, definitely. Thanks for that one, Zoe. So Archit, do you want to read this one?
Sorry, I read this one. I read the last one to myself tonight. Archit, is having overlapping ETFs a bad thing? So
another great question. Sort of as Tom sort of mentioned, it is something you want to look at. So there can be, particularly when you look at sort of the broad-based indices that we see today, a lot of that is dominated by the big tech names. And one that comes up a lot is Amazon. So Amazon tends to have a large holding, not only in global indices, but also the NASDAQ 100, also in sort of e-commerce thematic ETFs. So there can be a bit of an overlap there. And whether you consider that to be a good or bad thing will really just depend on your personal investment preference. But we do just advise that if you are sort of worried about that, you can always have a look at these underlying holdings. You can always compare ETFs and look to see if you're going to be overexposed to certain companies or certain areas there.
Yeah, definitely. Because if you do have too much overlapping and too many ETFs that have similar holdings, they have a very similar correlation. And when it comes to in-depth portfolio construction, it can be good to have uncorrelated assets in there as well. Isn't that right, Ben?
Definitely. That's great. Thanks for that, Archit. So Sam has asked, how would you build an ETF portfolio for both growth and income, or maybe growth or income?
Growth or income?
Yeah.
Again, it comes back to when you're looking at the various ETFs that are out there and the different goals that they provide. So you initially want to find out what your own goals are for investing, and they vary from person to person. Depends potentially on the stage of life you're in. If you're looking for a reliable or a consistent source of income, you can achieve that through more equity income style ETFs or fixed income style ETFs. There's no reason why you can't balance those goals, and by holding a portfolio of broad market ETFs that provide exposure to international and domestic equities, but also fixed income ETFs, you can provide yourself capital, hopefully stability and potentially growth, but also a consistent source of income. So how would you actually go about doing it? It would take a bit of research into the different ETFs that are out there in the categories. As Ben mentioned earlier, on the website, we do break it down into these different categories. You can actually learn about each of the different sections on the website too. So you can learn, what is an equity income ETF? Why does that provide both income from equities? And how does that differ to, say, fixed income ETFs? They also provide income, but generally considered more defensive traditionally.
Yeah, that's great. And sort of if you were looking to build a growth ETF portfolio, where would you look specifically?
Specifically, look, if I was talking just one or two ETFs, initially I'd look potentially to the NASDAQ 100. It's an ETF that I quite like. So just because it does hold a lot of the largest and most commonly known tech names in the world. So you mentioned Amazon earlier, Tesla, Facebook. These companies that are large technology companies that should have or might have good runways for growth in the future. And again, it depends how much growth you're looking for, because even the Australian market, can provide growth. But a lot of those companies are, your big banks or your resources can be considered a bit more mature, a bit more even value style oriented investing rather than growth. So potentially those tech style names, and also that plays into then, core and satellite, your thematic ETFs as well. They tend to be higher growth.
Yeah.
Those more interesting tech sectors.
Yeah, definitely.
Yeah, great. Thanks, Sam. And then Gordon's asked, what is the best way to track the main indices in Australia and the US?
Yeah, that's another great question. Thanks for that, Gordon. Look, there's a lot of offerings in terms of sort of the main indices in Australia and the US. So the benefit of some of these large, broad-based indices is that they tend to be very low cost because they are tracking quite popular indexes. So for example, in Australia, the big one is sort of the ASX 200. So you're looking at the largest 200 companies in Australia there. So we actually have an ETF for that offering. So that's the A200 ETF. And that's very cheap at 0.07% in terms of fees there. In terms of the US, you've got a few different options. So you can sort of look at a broad-based US index. You could also look at the NASDAQ 100, as Tom mentioned, which is sort of taken over in terms of market capitalization. And we also have an ETF that tracks that as well. But there's plenty of options available for those broad-based indices. And again, one of the key benefits there is they're ridiculously cheap.
Yeah, and I mean, even outside of the main indices, it's probably worth touching on too. So that's the easy way to get exposed to your large, broad indices. There are also other ETFs that still track the Australian US market, but they're tweaked in a little way, aren't they?
Yeah, definitely. So we have a number of sort of sector-specific ETFs. So if you want to make a play on a certain sector, or you're looking at certain companies with certain characteristics, one that we've launched recently is just a quality ETF. So you look at the Australian market, and you just weight that market in terms of quality. So you're getting a factor exposure to what a more traditional index, such as the ASX 200.
Yeah, and even further to that. So, if we look to the US, the S&P 500 can be considered a main index over there, along with the NASDAQ. And there are actually different ways you get exposure to the S&P 500. So there's a traditional market cap version, but also another thing you can look at is something like equal weighting. So rather than the largest companies having the largest weight, we have an ETF, the ticker code is QUS, whereby each of the 500 companies in the S&P 500 are given a 0.2% weighting each. So it just goes back to how diverse the range of ETFs available now are. You can track the main indices, sectors, different styles of tracking the main indices. So that's quite good for investors in that sense.
Yeah. So Sonia has asked, what is the best way to analyze ETFs if you are time poor?
If you're time poor. If you only have 1 hour, I'd recommend watching this webinar firstly. Look, there are lots of good resources online, but probably the best way I would find for investors to really research and get their questions answered directly. Sorry, will probably just be reaching out. We have a dedicated client services team here. You can email it at info@betashares.com.au, or you can give us a ring on 1300 487 577. If you're lucky, me or Ben might even be on the other end of the phone. But yeah, that's a great way. Just if you give us a ring and we can kind of answer those questions you're most confused about and point you in the direction of really good resources online or wherever else.
Yeah, it is tough if you are sort of time poor, because there seems to be such a large selection, as we've kind of discussed.
Yeah.
But yeah, feel free to give us a ring if you're sort of struggling with that at all in any way. Yeah.
And of course, if it's a path you want to go down, there's obviously financial advisors who can assist in those decisions as well. And look, finally in this section, David's asked, can I dollar cost average into an ETF, Ben?
Yeah, so another great question. Thanks, David. So dollar cost averaging, for those of us who don't know, is essentially, instead of investing in a single lump sum, so say you have $10,000 to invest, instead of investing that in one big lump, you might split that up over time. So you could invest $2,500 over 4 different periods of time. And what that allows you to do basically is to get an average cost. So if you're worried that perhaps the ETF or the stock you're buying is going to decline in price, instead of putting it all in now, you can split that over time. And you can certainly do that with ETFs. So in the same way that you would do that for a stock, so you purchase via a broker, but you can split it up into a number of different payments in order to get more of an average price instead of a single price at a single point in time.
Yeah, because I guess it's notoriously hard to time markets. So that can be an easier way to enter into ETFs and purchasing them.
Yeah, we know from experience it can be notoriously difficult to time markets there.
All too well.
All right, great. So that was our sort of first section there. So in a few minutes, we're just going to launch our second poll. But maybe before we do that, Tom, just tell us a bit about your personal investment philosophy, what might be in your portfolio at the moment in terms of ETFs, anything you'd like to share with the viewers?
Yeah, I'll keep it in terms of ETFs because the other parts of the portfolio might not be as going as well as I would hope or as would like. In terms of ETFs, look, I still, for my side of investing, I still consider myself quite young and have quite a long-term investment horizon. Really, where previously even some of my friends who aren't in the industry or as privy to ETFs, they put their money into a bank account. I tend to just put all my savings into ETFs. And so since I consider those my savings and I won't need them for quite a long time, I generally think to myself, more growth style ETFs could be beneficial because the hope is that over the longer term, those growth style companies. So as I mentioned earlier, the NASDAQ 100, that's actually probably the ETF that I top up into the most.
Yeah.
Just top up into there, dollar cost averaging in a sense because I get my monthly payment and I'll put a portion of that into there. So it's just dollar cost averaging rather than having a lump sum.
Yeah.
And then hopefully over the longer term, those companies that have historically performed well, which obviously is an indication of future performance. But the hope is they will perform well in the future. How about yourself, Ben?
So I kind of relate to Sonia, I think, just in regards to sort of having not enough time to look at all these different ETFs. So I really like a diversified ETF that gives you exposure to everything, and you can sort of just set and forget in that regard there.
Yeah, okay, great. Well, that wraps it up for the portfolio construction questions we had. And as I mentioned, do feel free to ask questions in the chat as we go. And we'll leave some time at the end to try and get through as many of those as well. What we'll do now, we'll launch the poll. So you can decide between the research phase, which, as I said earlier, is really the basics of ETFs. If you're just getting introduced to ETFs, we had a lot of questions just saying, look, just keen to tune in, don't know much, and would love to learn more. So that section really covers that. Or if you're more interested in the actual mechanics behind ETFs, so pricing, trading, kind of under the hood, if you will, index construction, depending whichever you prefer us cover.
Yeah, and yeah, looking forward to the live session at the end as well, Tom, where you guys can actually ask some questions of us live in the studio here at BetaShares.
Yeah, I'm sure there'll be plenty coming through. And as we said too, we'll particularly if we get a lot of similar questions or particularly good ones we like, if we can't answer them now, but we'll be putting a blog out in a newsletter next week. So those come out every Wednesday. You can sign up on the website.
Yeah. Tom, you've actually done a few good articles on our blog in the past.
I have done. I've done a few.
What was your most recent one? Was it robotics?
I think it was COP26. I did a summary of the COP26 summit that went on last year.
Yeah.
And tried to summarize some of the actual takeaways from there and how it could, have influences on our climate change innovation fund. Definitely, well, maybe worth a read. I'll let them decide.
I thought that one was great, Tom. Yeah, I was a big fan of that.
Thanks, Ben. Appreciate it. So it looks like once again we have swayed the vote with our preferences. So it'll be the ETF deep dive we're going into. So a bit more of the nitty gritty, if you will, and we'll kick it off right away with Wellington. And he's getting right into the nuts and bolts. But Ben, Wellington's asking you, can you explain how the market price of ETFs are derived? Is it based on sentiment like shares? Is there a formula? And how often is it updated?
Yeah, really interesting question, Wellington. So I guess we often talk about ETFs as being similar to shares in terms of the trading process. So you go to your broker, you enter a ticker, and you buy or sell. I guess the key difference between ETFs and shares in terms of that process is that ETF prices aren't really driven by supply and demand for that ETF. The way it works is that we actually have market makers. So market makers are financial institutions that are essentially negotiating with us to create and redeem new ETFs. So every ETF has a net asset value, which is the underlying value of the ETF based on the physical holdings in the ETF. So the physical companies within the ETF. Market makers will then work to price ETF units very close to that net asset value. And that's usually the price that you'll see on screen available. And usually if you're trading, you can actually see on the bid and ask market makers in sort of large trades there. So that's sort of what drives that ETF price. It's that underlying net asset value. And as that moves, market makers will price the ETF according to that movement. So there's no sort of algorithm, and it's updated as the underlying value of the shares move.
Sure. And I guess important here to touch on when we're comparing it to if you're just buying or selling a share with an ETF, and this comes back to the market maker's role, they're an open-ended structure. So we're able to create and redeem units to meet supply and demand in the market. And this is why they generally track the underlying value, because if we create, let's say, 100 more units, they actually are creating a much larger parcel size. We'll also buy the equivalent of the underlying. So what that means is you're not diluting the market by creating more units or by reducing the number of units there.
Yeah. And Tom, maybe just sort of for the audience, that makes sense when you have an Australian-based ETF and the price or the NAV moves during our trading day. If you have an overseas exposure like the NASDAQ, for example, how would that then be priced in terms of?
Yeah, very good question. So the structure is the same. So it's the same structure in terms of open-ended nature. We'll be able to create and redeem more units. But what is a bit more, or might be perceived as a bit more difficult, is the NASDAQ isn't trading when the ASX 200, when the ASX is trading, and the ASX is where all of our ETFs are listed. So how can we accurately be pricing a market that's actually closed? Well, the answer there is through futures contracts. So although the NASDAQ 100 isn't open during our trading times, there are futures contracts constantly trading for the NASDAQ. And those give us an indicative price of what the NASDAQ would be if the market were open. So based off those, market makers are able to get an accurate price of what the NASDAQ would be trading at, and that's how we price it. That's why it's really important, and we get this question a lot. People will look at their morning news and see the NASDAQ was up, let's say, 2% overnight. And then our NASDAQ 100 ETF will start trading that day. And they'll say, wait a minute, it's only up, maybe 1%. Now, there are probably two main reasons that it could differ. Two main ones. The first one's one I was just alluding to. The futures contracts might have changed since the close of the NASDAQ market. So that's why you're seeing a difference there. And that happens more in volatile times.
Yeah.
The second one is to do with currency, and we'll probably get there with questions later on.
Yeah, so it looks like Adam's just asked that question. So why doesn't the share price of the NASDAQ 100 follow the actual index?
Yeah.
So Adam, hopefully you're satisfied with that answer.
Should we touch on the currency aspect as well while we're there?
Yeah, sure. So I guess, another sort of key factor in that equation, Adam, is currency movement. So because it's an Australian listed ETF, it's listed in the Australian dollar, whereas obviously the NASDAQ 100 index is US based. So all of the companies there are listed in the US. So that difference there, the difference in performance can not only just be due to the fact that the NASDAQ trades overnight, but also due to the fact that if the Australian dollar moves or the US dollar moves relative to the Aussie dollar, what you're actually going to see there is a slight deviation in the price. And the way you can prevent that is using a currency hedged ETF. So as Tom mentioned, with our NASDAQ 100 ETF, we have the same ETF that removes the currency impact of the US dollar and the Australian dollar. And the ticker for that one is HNDQ, but basically just giving you pure exposure to the index without the impact of US dollar or Aussie dollar fluctuations.
Yeah, great. There you go. First deep dive question. We've taken probably more time than the entire first
Yeah,
section.
I think they covered a few.
Just to show the under the hood nature of this, this section. I think you're up next reading the question, Ben.
Yeah, what have we got? From Al. So this is a good question, also one we get quite often. How liquid are the smaller funds?
Yeah, really good question. So, and this a good follow-on question, because it does come back to the creation redemption mechanism we touched on earlier. An ETF is generally going to be as liquid as the underlying holdings in that ETF, and the reason being is if there was a sudden surge of demand in an ETF, or a single buyer looking to buy more than the entire holdings of the current ETF, we can create more units by purchasing more of the underlying assets, be it equities, be it whatever it is. And so as long as the underlying assets are liquid, and for most ETFs, so we keep referencing the NASDAQ 100, but those are some of the 100 largest companies in the US. So that they're very liquid and they trade a lot more volume together than the ETF will be trading. And it's a really important consideration in index construction and index selection for an ETF, because if you made an ETF that was tracking underlying assets that were not liquid enough, well, you couldn't effectively have this creation redemption process. And there's actually been instances in the past, none of our funds, thankfully, we spend quite a bit of time ensuring that when we select an index, it will be liquid enough. There have been instances in the past, I think of a few in the US whereby actually the ETF got so large and the underlying assets were not liquid enough. And so in those instances, it can cause issues. But it's a pretty important thing that we consider when constructing our ETFs.
Yeah, so you'd say it's always important to look at sort of the underlying liquidity of the holdings of the ETF.
Exactly right.
The volume traded on that specific ETF.
Exactly right. No, good question there, Al. The next one we have is Sean. Sean's asking, do all ETFs rebalance the same way? i.e., do they change their holdings in line with an index? So I guess there's a few parts to this one, potentially even touching on index ETFs versus non-index ETFs as well.
Yeah, sure. So with this one, Sean, so yeah, ETFs will, if they're an index tracking ETF, actually maybe we'll just start with sort of index versus non-index ETF. So most of our ETFs will track an index, so there'll be passive products. And what we mean by passive products is that usually there's a rules-based methodology behind it, there's low turnover in the fund, and we'll rebalance that fund based on the index every sort of quarter or twice per year or once per year, depending on the specific methodology. Active ETFs are slightly different. So active ETFs will be basically a manager selecting stocks, but specifically for index ETFs, we'll always try and rebalance based on changes in the index. So we really are passively following an index. And what will actually happen is if we sort of fail, or if a manager fails to track an index, by rebalancing at the same time. If they rebalance late or early, what can actually happen there is you get tracking error. So the price of the ETF and the performance of the ETF will deviate from the performance of the index. So Sean, yeah, for most cases, you'll find that our ETFs will rebalance at different times, so quarterly or semi-annually or annually, but they will change their holdings in line with the index and the indexed methodology.
Yeah, exactly right. And we didn't obviously get onto the research phase in this session, but a lot of people were asking, how do you compare ETFs? And when you're looking at, like ETFs, so if there's two ETFs both tracking the ASX 200, one of those factors is looking at the tracking error. So how well is the manager actually tracking the index to that point?
Yeah, definitely. Great, thanks for that, Sean. So David has asked, when an index rebalances and that flow through to the ETF, does that lead to dividends that might be higher than the underlying shares?
Yeah, good question. So this question is around how distributions are derived in ETFs. It's the same for managed funds as well, actually. But in terms of ETFs, there are two main sources of income that are passed on to unit holders by way of distribution. And those are the underlying dividends paid by the companies. And the second one, which is what David is alluding to, are capital gains, or rather net realized capital gains on the rebalancing of portfolios. So just like if you're an investor buying and selling shares, and if you realize the capital gain, that would cause a tax event. You have to obviously pay tax on it. Within an ETF, when we're rebalancing or buying and selling shares, at the end of the financial year, we can have a net realized capital gain. Now, generally, those capital gains can or do get passed on to unit holders by way of attribution and usually by way of distribution as well. As Ben touched on earlier, one of the benefits of passive index ETFs is you tend to find less turnover, particularly when comparing to an active manager. An active manager will generally have a smaller portfolio, higher conviction, doing a lot of trading, whereas an index ETF might only rebalance, let's say, 4 times a year.
Yeah.
And those top 100 companies don't change too much, generally speaking. So they can be fairly tax efficient, those passive index ETFs, in terms of this capital gain being passed on in a distribution.
Yeah, and that's in addition to the dividends from the underlying shares.
Of course, yeah. Thanks, David. The next one is from Richard. This is one we get quite often when people call up asking about the DRP function, which is the distribution reinvestment plan. So Richard's asking, I use DRP for my holdings in my ETF portfolio, which pay, so he's using a fixed income ETF that pay monthly distributions that tend to be, relatively consistent, but potentially quite small. So what happens to the remainder if the dividend or if the distribution is less than the value of a single unit, Ben?
Yeah, that's a really interesting question, Richard. So I guess the most important factor there is to recognize that you're not losing that extra bit of distribution. It's not just disappearing into thin air. BetaShares doesn't take it to keep for ourselves or pay bonuses or anything like that.
That'd be handy.
Yeah, it would be handy. The way it works is that sort of additional leftover distribution or dividend just gets held in your account until the next distribution. So that will then be in addition to your next distribution that you receive, and if that adds up to a full unit, you'll receive that unit through the DRP.
Sure.
But it's basically, it's kept in your account. If you were to then sell the ETF and rebuy at a later date, you'd still have that additional distribution amount. And eventually that would add up to a unit, assuming that you're holding the fund for the long term. So worry not, Richard, that distribution is safely held in your account there.
That's good.
Paul has just asked, how do ETFs that hedge their positions work?
Yeah, good question. We briefly touched on earlier currency hedging and the difference between a non-currency hedge and a currency hedged ETF being that you eliminate the fluctuations of currency. How we actually hedge those positions? So we hedge those using currency forward contracts. So those have a counterparty, and when the currency moves against you, is where you can see in a traditional non-currency hedge ETF will receive the benefits, so it will offset the actual move in the currency, and vice versa, is to try and put it in simple terms.
Yeah, so just using sort of a more complex financial instrument that we manage that internally, that investors don't have to worry about that from their side.
Yeah, exactly right. It's all done internally, and the team here just manages that position.
Yeah, perfect.
Great. And then Dion is asking, is it possible to have an ETF with only, say, 5 or 10 stocks maximum? I like this question.
Yeah, really interesting. So yeah, in themes, he's asked in themes such as high growth, income, small caps. Yeah, so a really good question. There actually are a number of ETFs that do hold sort of fewer individual stocks. But basically, I guess the key consideration here is that the ETF is just a wrapper for a managed fund or a traditional managed fund structure. So you can hold whatever you want inside of that.
Could you hold just one stock?
You could hold one stock, you could hold 2 stocks, you could hold 1 billion stocks.
There you go.
It's all possible through the ETF wrapper. As you sort of mentioned, Dion, the reason why we don't do that is because an ETF with only 5 stocks or 1 stock wouldn't be particularly diversified. You'd probably be better off just going into the market and purchasing that 1 stock rather than going through an ETF manager and paying fees. So that's sort of the reason why we don't have those sort of very, very concentrated ETFs. But it's certainly possible. As you mentioned, there probably would be more volatility in that, but it's certainly possible.
Yeah, and I like that, what you said originally, how an ETF really is just an investment vehicle. A really efficient investment vehicle that trades on the market, that has all these great benefits, but what's underneath it, that's why you can have passive funds, active funds, a fund with 1 stock if you wanted to. It's just the vehicle's quite an efficient way to invest, really.
Yeah, really a marvelous creation. So Robert has asked, being old school, presumably an old school investor, Tom, I have this impression that ETFs are totally artificial, synthetic products that could just disappear into thin air if economic times got tough. Comments, please.
Well, again, luckily, not luckily, but by way of their makeup, ETFs are quite safe, and actually majority of ETFs are backed by physical assets. So if an ETF, even actually, sorry, I'll say it again, all ETFs are backed by physical assets. There are some that are synthetic, but even those are backed by the cash in the fund. And all those assets are held by a third-party custodian for the rights or for the benefits of the actual unit holders themselves. So, again, using an example here, the ASX 200 fund, or A200 ETF, which holds the top 200 companies on the ASX, those equities are actually purchased and given to this third-party custodian for the benefit of the unit holders. So rest assured, Robert, the actual underlying is there. And a good case study if this really is, and this question's come up since ETFs began, really, because the first ETF, I believe, was back in 1991 in Canada, if I'm not mistaken.
Long time ago.
It was, and there's been many market cycles since then. We've had the dot-com crash, of course, the GFC, more recently the COVID crash, and we tend to find after each of these events, skepticism is healthy, and it's good to learn, what's actually behind the scenes. But we've seen time and time again, ETFs have stuck around. They haven't just disappeared when times got tough, and the actual structure and the physical backing of the assets has held up.
Yeah, that's really great, and it brings me a lot of peace of mind as an ETF holder myself. I guess sort of to dig a bit deeper there, Tom, and this is a question we get a lot as well. What if BetaShares was to sort of go bankrupt? What would happen to our assets in that case?
Very good question. And again, it comes down to the structure of ETFs being this unit trust structure and that third-party custodian that I mentioned. So since those assets are held by the third-party custodian, if BetaShares did go bankrupt, those assets wouldn't be available to our liquidators. What would realistically happen is likely one of 2 scenarios. Either another fund manager would actually just come and begin to operate that ETF as per normal, or the ETF would be liquidated itself, and the benefits or the benefits of the sale of the underlying assets would be paid out to the unit holders at the fair value. Yeah,
that's great.
Thanks, Robert. Good question there, an important one as well. And then look, we've got one here from Margaret. So Margaret is wondering, when registered, I asked, how do ETFs provide income and capital gains? So how do they actually provide income and capital gains, and how do you determine the performance of an ETF, Ben?
Yeah. So Margaret, I think we've kind of covered this a bit earlier, but I guess the core component here, so if we talk about first capital gains, the way that that's reflected in the ETF is just in the unit price. So it's very similar to a share. So what will happen is the price of the ETF will go up or down. You can then purchase or sell at your willingness. So capital gains are sort of achieved if you purchase an ETF, the underlying companies in that ETF then increase, you then sell the ETF, that's you making a capital gain. The second component there of income, usually in most cases, so for equity ETFs, that's the dividends that we receive from the underlying companies. In the case of a fixed income ETF or a bond ETF, those are coupons that we receive from the bonds and then distribute out to unit holders. So those are sort of the two sources of return. As Tom mentioned, you can also get internally generated capital gains, but really those are the two key ones where you're either making a gain or loss from selling the ETF, or you're receiving dividends from the underlying companies held within the ETF.
Yeah, and in terms of how to determine that performance, obviously you could track it yourself, knowing, you know, I bought this ETF at X price, it's now at Y price, that's your capital return, and also you might have been receiving distributions into your account, so you can see it that way. But also probably an easier way to keep track is just via the relevant fund manager's fund page, or even your online brokerage account. But on our fund pages, we have the full fund performance. We have that inclusive of capital gains and distributions. We have the distributions broken out. So a lot of good resources there to check out on the fund website as well.
Yeah, it's a very useful resource there. All right, so I think we're going to jump into the live questions, and it looks like we've already got a bit of a backlog here.
Me too. Maybe to go rapid fire if we can. We'll see.
That's it. So we've got about 20 more minutes left. Might just get straight into it, Tom.
Let's do it.
So Santosh has asked about a trend toward ETFs rather than index funds, and seeing that many of the index funds have been closing down. Is this because of ETF popularity / liquidity, or for other reasons?
Yeah, and so is Santosh here talking about ETFs versus traditional index managed funds?
Yeah, so unlisted.
Okay. Yeah, great. Yeah, so because it's a good point. A lot of people do associate ETFs with index funds because the rise of the two has come largely together. But as Ben and as we touched on earlier, an ETF really is just a trading vehicle and anything can be underneath it. So prior to ETFs, there were index funds that were unlisted. So they're simply, you know, tracking passive indexes like most our ETFs do now, just in the unlisted format. Now, the reason we're seeing a trend towards ETFs, we're even seeing, you know, active managers who traditionally use the managed funds investment wrapper moving to ETFs, just because of some of the efficiencies that ETFs provide. With a traditional managed fund, you know, they're considered less liquid because they're not trading live like an ETF does. You can buy an ETF all the time during the trading day. That also gives you live pricing of an ETF, which you don't necessarily have with a managed fund. So it's a lot of these benefits we have from being in the ETF wrapper and a listed vehicle. I think that's why we're seeing the trend towards ETF popularity over your traditional managed funds, specifically when they're both, you know, just tracking indices.
Yeah, and is that sort of a trend you think will continue? We'll see more ETFs and less index funds in that traditional?
I think we will. I think, you know, it's pretty well known now, the benefits of ETFs, and that it really is a great, efficient trading vehicle. And that, you know, the majority of index funds now would be ETFs, I would imagine. And we'll continue to see that, you know, that trend continue. And I also think we'll continue to see more and more active managers who are traditionally unlisted move to a listed format as well under the ETF wrapper, just because of those efficiencies.
Yeah, that's great. Thanks for that, Santosh.
Good one, Santosh. The second one we have here is from Sally. Sally's wondering, do you have any trading tips, Ben?
Yeah, so unfortunately we can't sort of recommend any specific ETFs or our own, you know, share our own personal
favorite
trading
stock picks.
Yeah, we can't do that, unfortunately, Sally. We can give you sort of some information just around trading ETFs more generally. So when you look at trading ETFs, as we've sort of discussed, market makers are usually available and they will usually be pricing these ETFs at a price of very close to the net asset value. Some of the general things that we always recommend, firstly, is to ensure that you're trading after the first 10 minutes and before the last 10 minutes of the trading day. So during these times, often market makers might step in or out of the trading, just because, particularly for Australian listed ETFs, that's just a time period where stocks are starting to open, and they open at a staggered pace. So we sort of recommend that you make sure you're trading between sort of 10:10 and 3:50. So just after the start of the trading day and before the close. Another sort of key thing that we like to recommend is, for all of our Australian ETFs, we publish an INAV. So that's the intraday net asset value. That's a live valuation for ETF units. So if you're looking to trade, it's always worth just double checking that and then comparing that to the market maker price, just to make sure that that's accurate, and you're not going to get a bad trade there.
Yeah, great. And then that kind of builds into the whole using limit orders over market orders as well.
Yeah, so forgot about that one, Tom. Thank you for reminding me. So limit orders versus market orders. Limit orders, usually you're setting a price, and your order will get filled at that price, assuming there is demand or supply. Whereas with a market order, you just receiving the sort of the last market price. So we always also recommend that you set a limit order, just in case volume suddenly dries up and you get a bad trade there.
Yeah, great.
Thanks for reminding me on that one, Tom.
No worries.
So Tyson has asked, why is the management fee on all ETFs, exclamation marks, different? Why not a set fee? So why not have a standard fee across all ETFs? Why are they different?
I like this question. Yeah, it's a good question. But I guess we have to think about what the underlying exposure is giving you. And also, I mean, for different ETFs, there can be different costs of even providing that ETF. So if we start at one end of the spectrum, your most basic ETF would, for Australian investors, would be an ASX 200 ETF or Australia 200 ETF. This just tracks the 200 largest companies on the Australian market. And there are a number of even index providers who provide that same index. So you're able to do it for a very low cost. So for instance, our A200 ETF comes in at 0.07 basis points per year, which is actually the lowest raw market Australian exposure you can get in the market. Now, that's low cost, as I said, because it's a fairly passive vanilla index, easy to track and easy to replicate. If you look towards something more complicated or something more niche, something like our climate change innovation ETF I'll go to next, the reason why this one might be or is more expensive is because the actual makeup of the index is more complicated. Even for that one, we use an external data provider called iClimber. They're a London-based green fintech company, and we need to use their expertise in constructing the index for this ETF and ultimately what stocks go into it. So there's additional costs there, as you can imagine. And that's just one example. But if you look to a gold ETF, you need to factor in things like storing the actual gold and audit costs. So the underlying fees generally do differ with a lot of the underlying costs in ETFs, and then also how unique the exposure is. Can anyone else provide it? So that's kind of a broad understanding.
Yeah, no, that's great. I think that's great.
Okay, great. Yeah. And then Barry has asked us, can you explain the distribution of franking credits in equity ETFs? So, I mean, obviously, investors who are used to shares, they receive their franking credits. Do you receive franking credits in ETFs?
Yeah, you certainly do. So for Australian equity ETFs, when we receive those distributions, or I guess when investors hold shares in Aussie equities, they also get that franking. The same thing for the ETF structure, and we just distribute those franking credits out at the end of the financial year. So every time you receive a distribution, you'll get sort of an estimated franking amount that we estimate, and then at the end of the financial year, we'll hand out those franking credits along with any remaining distributions. So you'll receive all of that in the same way as if you were holding shares through that process.
Okay, great. I like franking credits.
Yeah, I'm glad to hear, Tom.
That's good news.
So Penelope has asked, when you start a new ETF, who is getting? Oh, this is a great question. Sorry, when you start a new ETF, who is getting the first shares that start trading? I.e., who gets in at cost price?
Good question, because if you're looking through the lens of a share or a company and a company's IPO, there's obviously the initial initial offering, and getting in early can be perceived as good because if it's a successful IPO, if you're first in, the share price can absolutely fly, right? It's different for an ETF. As we touched on, it comes back really to the market making and the net asset value and the open-ended nature of ETFs, whereby it's actually not as important to be first in terms of an IPO, because the extra demand for an ETF isn't going to impact the price. What's going to impact the price is the actual movement of the value of the underlying companies in the ETF. Now, to specifically ask your question, when we create a new ETF, generally it is seeded by market makers or authorized participants. Ben touched on quite a bit earlier who market makers are and the role they play, but they'll make an initial creation. So they'll provide us with, let's using a simple example, let's say the ASX 200 again, they'll provide us with the 200 stocks that comprise the ASX 200, and we'll provide them units in the ETF. Yeah. And on the first trading day, when you or me go to buy the ETF, the market makers will be there providing buy and sell amounts for us to go in at the fair value. And then importantly, and this is where it differs from a share, the initial day that the share, there's lots of demand, it's going to move the share price up quite a bit because there's a limited amount of shares. If the first day for an ETF, there's a huge amount of demand, simply the market makers or the authorized participants will come back to us, say, hey, we need more units, here's more of the ASX 200 shares, and we give them more of the units. And that's why they trade at that underlying fair value rather than being impacted by supply and demand.
Yeah, I think that's really important, particularly in terms of thematic ETFs. So one that we launched quite recently was the Crypto Innovators ETF, and we had a lot of investors calling in asking, how can we get in at cost price and sort of beat the curve and get in early? It is important to recognize that the price of our ETFs isn't necessarily driven by demand for those ETFs. It's based on the underlying holdings.
Exactly right.
As Tom mentioned.
Yeah, exactly right. Thanks for that. Pretty interesting one.
Great question.
Mike has asked us, when a diversified ETF is composed of a number of underlying ETFs, does an investor end up paying admin fees for the underlying ETFs plus the admin fee for the diversified fund? Yeah, good one, Mike.
Yeah, so another good question we get quite often. The way we you basically do sort of pay for the admin of the underlying plus the admin of the overarching ETF. However, that's all built into the management costs associated with the diversified ETF. So you just need to look at one number there. So for example, for our high growth ETF, the fee for that is 0.19%. That covers all-in costs for the diversified ETF plus the underlying costs.
Correct.
So you don't really need to dig any deeper than that. We've made it very easy for investors, and it's the same for most diversified ETFs that you'll see available. It's very easy for investors to just look at a sort of a top line figure.
Yeah. Because what's interesting there, because we haven't touched on it yet, but with fees in ETFs, they do come out of the value of the fund. So intuitively, you'd think if I'm holding a diversified ETF that's taking this fee out, and these underlying funds are doing the same, you might be getting double charged. What the funds will actually do is reimburse the underlying fees and then just charge that headline fee. That's how we get around that.
Yeah, definitely. Perfect. And it looks like we've got time for a couple more here. A few minutes left. So Andy has asked, do all ETFs pay forward the dividends their component companies receive? We sort of touched on this earlier.
We did a bit, but we can dig a bit deeper. Yes, but net of any fees and expenses. So dividends and franking credits are passed on in full, but those may be reduced by fees taken. As we just mentioned, the fees come out for an ETF out of the value of the fund. So that might pull away from the dividend pool that's in there because it's more efficient than, let's say, selling down an equity to pay those fees. So yes, but net of fees is the easiest way to answer that one.
Perfect.
Thanks, Andy. Look, we've got one more question here from Peter. Lucky last, Peter. All he's asking is there a single ETF that diversifies in world index shares, bonds, cash, gold, etc.? So a lot of asset classes there.
Yeah, so we do sort of offer a number of diversified ETFs. Tom mentioned them earlier. The tickers for those are DZZF, DGGF, DBBF, and DHHF.
Well done.
Yeah, quite a mouthful there. But yeah, those will give you sort of exposure to global shares, Australian shares, fixed income, a bit of cash as well. We don't have any that sort of include commodities, but that might be something that might be worth sort of looking into a bit deeper there. Peter, yeah.
Probably worse, I think compliance will be happy with us with the caveat that the DHHF doesn't have any fixed income there. That's just global equities and domestic equities.
That's right. Yep. So always a reminder to check the website. Don't listen to what we tell you here today. Just make sure you're checking fact sheets, checking PDSs for the underlying holdings.
Perfect. Well, I think that's been about an hour. We've covered quite a good range of questions there. As mentioned, there's still a lot more asked before the session, a lot more asked in the chat. So we will try and get to as many of those as we can. And then look, if it was successful, we might just do it again.
Yeah, I'd be very keen to do it again, Tom. Yeah. So yeah, just sort of, you know, obligatory legal disclaimer at the end here. So just a reminder that investing does involve risk. So share funds come with market risk, bond funds come with interest rate and credit risk. The value of investments and distributions can increase as likely as they are to decrease there. So before making any investment, just consider the relevant PDS and particular circumstances, including sort of risk tolerance, and there's always the opportunity to look for financial advice from an advisor or a broker there.
Couldn't have said it better myself.
Perfect. Thanks so much, guys. So Tom and I will be hopefully back for another session in the future one day.
Look forward to it, Ben. I'm sure.
Depending on what the overlords say.
Everyone else does as well. We could be cut. This could be the end of it.
This could be it. The first and last. Ben and Tom.
Perfect. Thanks, Ben.
Perfect. Thanks, Tom. Thanks, guys.